Welcome into a special edition of the Informed Investor Long-Term Thinking Market Update. I'm Rob Black. Joining me today, the Managing Director of Investments at EP Wealth, Adam Phillips. Yesterday, which was referred to as Liberation Day, where Donald Trump revealed his tariffs and what they look like and how they're going to go into effect. One commentator referred to it as worse than the worst case scenario. I'm going to turn it over to you, Adam. Give us an update on what you saw yesterday and where we are today.
Sure, Rob. Well, look, heading into this widely anticipated event, we were thinking about all these various scenarios, and the reality actually came in pretty close to the worst case that we had in our minds. I don't know if it was worse than the worst case, but it was up there for sure. Let's talk about the details. We saw a 10% universal tariff rate that was applied to to imports from all countries. Now, there were two notable countries that were excluded from this. That is Canada and Mexico. They still have other tariffs that apply to them, but they were, I guess, relatively speaking, they got off easy yesterday. What we did see in addition to those universal tariffs were retaliatory tariffs, and those were really aimed at about 60 countries, and they're going to pay more than 10%. And those are seen as really the biggest offenders in terms of contributing to our trade deficit. So the European Union, 20%. We saw Vietnam actually close to 50%. So really big numbers here. And so I think that is certainly it threw people it threw people off for sure. It was worse than many anticipated. What this really means is based on these assumed tariff rates, it's going to take our average effective tariff rate in the U.S. from currently about 2.5%, where it's been for some time, to I've heard estimates as high as 30%. I've heard as low as 18%, but let's just call it 20 or north of 20% for now. That is extremely high. It's the highest tariff rate that we've seen in over 100 years. Now, I want to say what's different now versus 100 years ago is that we import a lot more as an economy than we did back then, about 3 times more. So I think the impact to our GDP, to importers, is going to be a lot worse this time around.
Okay. So let's talk about the motivation of the timing of this and the depth of it. What do you think the president was thinking, and where do we go from here?
Yeah, I think it's hard to really know what the motivations are. I can't speak for President Trump, but I could chalk it up to a few things. I mean, obviously, he's mentioned that he mentioned yesterday he wants to make America wealthy again. If you look at the stock market reactions today, I don't imagine this is really helping in terms of adding to the wealth of Americans, at least those that own stocks. But this is a long-term plan, and he's talked about the plans for reshoring, bringing manufacturing back to the U.S. So that is certainly one motivation, as well as righting the wrongs from the past and the fact that some of our major trading partners have had it easy in recent years, and that's why our trade deficits have exploded. So I think those are two of his motivations. I will just say on the manufacturing, look, it's fair. I think it's many are certainly supportive of the fact that they want to bring jobs back to the U.S. I will say this is, we're talking about short-term pain for long-term gain. Bringing manufacturing back to the U.S., it's going to take years and a lot of money. And so I think it's just going to remain to be seen if that can actually happen. I'd hope that it does. I think President Trump's other motivation, though, is paying for tax cuts. We're so focused on the deficit right now, and so obviously some income that could come in through tariffs would help to bring down our deficit and help to perhaps justify or push some of these tax cuts through that President Trump campaigned on. And so I think this is certainly on his mind as well.
I heard one analyst refer to the current market conditions as the first 15% down from all-time highs is tied towards inflation and a correction on valuations. Another 15% would be implying a recession. So I know you're not a technician, but technically speaking, how do those numbers jive to you? How does that sound? Is it in the ballpark? Is it in the right theory? Is it the right way to think about it, or do we need to be more dynamic?
I think it's fair. So historically we've seen you see a 10% correction every couple of years.
Yes.
And so we've had one. We hit 10% a couple weeks ago, and we've since revisited that this morning and gone a little bit lower in terms of the S&P 500. Now, as we think about that next step is that 20% level, that's a bear market. And so many people just assume that a bear market happens when there's a recession. We can have recessions that occur without getting into a bear market,
Mhm.
and you can have a 20% decline without a recession. So I think it's not the case every single time, and so I think that's why every situation is different. Let's just you mentioned the Nasdaq tech heavy tech heavy index. This is an index that has been really the big winner here in recent years. And so, one could argue it's coming back down to reality. It's had it very, very easy. So it doesn't really make days like today or weeks like the recent weeks that we've seen that much easier. But I think it is important just to think about where you're coming from. I would just say, look, these things are normal. These things they take time to play out, but this is to be expected every couple of years. Now, ideally, it's not the result of something that appears self-inflicted. But we've seen this, whether it's a crisis that you don't see coming or something like this that is more self-inflicted. I think it's important to just acknowledge that. We are not in a recession yet. We're not in a crisis yet, but this is, I'd say, very normal and par for the course.
You talked about potential tax cuts coming in the back half of the year. That would probably be a stimulus for the stock market, maybe a potential stimulus for the economy. Let's talk a little bit more about the back half of the year based on this. I'm not expecting a 1 day shakeout or a 2 day shakeout. Typically, it takes a little bit more time than that. What's your thoughts on timing in the next couple of months as we start moving towards potential catalysts?
Yeah, well, look, I think let's just acknowledge the very short term here. This is a very fluid
Mhm.
environment, and so we are recording this on Thursday morning, and so we just had this Liberation Day yesterday, and so it's all very, very new. We are waiting to hear very anxiously waiting for a response from our major trading partners, some like China, some like Europe, that have said they're going to retaliate. So I think right in front of us, those are some of the things that are on our mind. But as we think to the later part of the year, let's again just think back to some of those motivations for President Trump and using the tariff revenue to help pay for or justify some tax cuts, those tax cuts that he campaigned on. Looking at the numbers, these tariffs would generate, by some estimates I've seen, over 600 billion in revenues this year. That is actually about 100 billion more than the US collects every year in corporate income taxes. And so I think that's really meaningful. I mean, if you want to take it to an extreme, you could say we could eliminate corporate income taxes if we have these tariffs in place, and that would help to offset some of the pain these corporations might feel. I don't think they're necessarily going to do that, but I think it helps to justify bringing that corporate tax rate down if that is something they want to do. The other catalyst as part of that the tax changes that are likely coming in the back half of the year is making those individual tax cuts permanent. They were set to expire. They were originally part of the Tax Cuts and Jobs Act, and so those were set to go away. Trump has mentioned that he wants to make those permanent, and so it's another catalyst. But I do just want to acknowledge the fact that this is if we need to set our expectations for how much this could really move the needle in terms of the
Mhm.
economy. These are, I think we actually talked about this in Monday's update, Rob. These are not new tax cuts. These are it's an extension of the tax cuts that were already in place and put in place as part of that Cuts and Jobs Act in 2017. And so this is, rather than viewing it as a tailwind, I think it's more that it's removing the potential headwind from the economy going forward.
I'm a little bit older than you, and I remember the 1980s. I was in high school, and we had Ronald Reagan as the president, and he didn't have Make America Great Again, but he had Made in America. And Bruce Springsteen, I was born in the USA, and we had farmers and farm aid. We had some tough times there, but in a very similar level, cutting taxes probably helped stimulate us out of it. Do you see any parallels to the Reagan era and Made in America? All the tags that we had in our clothes back then, with potentially Made in America with MAGA in this current cycle?
Yeah, I mean, look, I can see a little bit of that for sure.
Okay.
And I think that it would, if we do see those tax cuts, I think any support you can provide to at the household level, it would go a long way towards restoring confidence and support spending. I think what's tough about what was the tariffs that were just announced yesterday is that it comes at a time when the economy is already showing some signs of weakness. We've been dealing with this what we've called the K-shaped economy, or just saying that it's an economy of the haves and the have-nots,
Mhm.
where those that own stocks that have a house with a pretty favorable mortgage rate they locked in a few years ago, they're relatively speaking, they're sitting pretty. It's really those lower income households that are struggling more, and they're likely to take an even bigger hit as a result of these tariffs. And so I think some clarity on tax cuts and to whatever extent that it can help support certainly the lower income segment of the economy, I think it goes a long way.
So, what's does this mean for our economy? I know jobs are super important, and I know that the Fed has two mandates to keep jobs at full employment, but also to fight inflation and keep it roughly around 2.5%. The Fed's in a bit of a pickle here, but they also have to wait and watch the jobs numbers to see where to land.
Yeah, no doubt. Look, as I said, this announcement comes at a time when the economy, I
Mm,
don't want to say we are already on recession watch, but we were mindful of some things that were going in the wrong direction, right? Just looking at some of the surveys at the business level, capital expenditures, or those really plans for spending among major corporations were trending lower amid this uncertainty. Confidence among consumers and their expectations for where inflation was going. It was that those were moving in the wrong direction. Even today, just the regularly scheduled economic data that we received, we saw continuing jobless claims rise to the highest level in a few years. And really what that is it's a weekly figure that we get. And it's really just those who continue to file for unemployment benefits. And so that tells you that the jobs market is already softening. And then also today we saw a weaker data on the service sector of the economy. So we're already kind of dealing with these headwinds, and the recent announcements do not help. Tomorrow we have the jobs numbers that we'll be getting for the month of March. We've been looking for, let's call it, between 130,000, 150,000 jobs being added in the month of March. We'll see where it ultimately comes in. I think it's going to be really important, though, to focus on the trend going forward. This is just 1 month, and 1 month does not make a trend. I think that now we are starting to deal with more concrete facts, even though it is a fluid situation, and some of these tariffs might actually go away. I think it's going to be really interesting to see what the latest facts and actually do for business confidence and their plans to hire. And so I think the labor market's going to be something that we want to watch going forward. Looking at all of this, we could talk about inflation, we could talk about the growth outlook. I think both are very, very important, but to us, we're actually more focused on the growth outlook going forward. I think that with tariffs, we do view them as a tax, we do view them as inflationary, but I think that in this environment, we would think that the inflationary hit would likely be short term, and ultimately we'd actually see a disinflationary trend because we expect that consumers would eventually push back if businesses tried to push through those higher prices, pass them on to the consumers. They'd actually say no. They were willing to take it a few years ago, but that's when the economy was in a much different spot. If we see the labor market start to weaken, we start to see the jobs market start to soften, people having a tougher time finding employment. That's going to lead to lower demand. Lower demand leads to lower inflation. So I think it's really what we're focusing on is the economy here and the fact that it is softening, that the odds of a recession have increased, not necessarily imminent, but certainly
Tax
our
cut,
guard is up here. When it comes to
tax
the
cuts.
Fed here, Rob, yeah, their next meeting isn't until May. It's a little bit more than a month from now. They're not expected to cut there, but I was joking about it earlier with someone. Maybe it's gallows humor, but I think if there's anyone having a worse day than me today, it's Jay Powell.
Yeah.
And because it really just puts them in a tough spot right now. They were already in a tough spot, and you almost wonder if this is President Trump's way of forcing rate cuts, which is something that he's been very open about, that he wants the Fed to get on with it. They've been pausing here for a while as inflationary data has remained sticky. We've seen a pause there in the downward progress, and so the Fed has been on pause. They've been data dependent. They want to wait and see how things play out. If they actually see with these latest announcements that the economy is at risk of deteriorating sharply, they might actually come out with insurance cuts and provide some relief to the economy. And so I think that's what's going to be really interesting to see is, do they actually focus on that inflation side and the fact that inflation hasn't been fully defeated yet? Or are they going to focus on really making sure that we don't do a ton of economic harm as a result of these latest announcements?
I like that there's options, and it's kind of in the back of my head. I know this is a dynamic situation. It's not static, even though it feels very static. I've never used the phrase silver lining playbook, but I think the silver lining here is the 10-year treasury is down to 4% today. And that can make housing costs go lower with mortgages. It can make our debt servicing in the United States go lower, saving us billions of dollars with debt that we issue. So there is a silver linings playbook here. Let's talk a little bit more about EP Wealth. How are we positioned as a firm in an event like this where it looks like the market's repricing? Instead of saying, let's hang out at the 20 times earnings level, maybe we go down to the 16 to 18 times level. And again, you don't have to talk about valuations. You can talk about how is EP positioned, but if you want to talk about valuations, you can as well.
Yeah, well, look, you mentioned that the silver linings playbook and the 10-year treasury that just fell below 4% this morning, and that was actually the first time getting below 4% since October.
Mhm.
And I think that's probably a good place to start. And that is the reason that bonds still deserve a slot within a portfolio.
Sure.
We are diversified investors, and for our balanced portfolio strategies, we still utilize high grade and fixed income, and that could include treasuries in this case. And it's those areas that are actually providing some relief here today and in recent weeks. And we actually saw in the first quarter the bond market actually returned about 2.5% or so, outperformed the equity markets by a wide margin because of the volatility that we experienced. And so we're seeing that again today, and that's the reason that you want to be diversified here. As we focus on the rest of the allocation, I think diversification, focus on quality, those are the themes that you see throughout. We have an overweight allocation to large cap stocks. That is an expression of quality to us.
Mhm.
And to us, this is really saying, look, small cap stocks have had a really, really tough time. And one can argue that if that they might actually be a good place to hide if you're worried about investing in multinational companies, most of which are found in the large cap arena. But at the same time, if you do have concerns around the growth outlook, maybe you don't want to lean into small cap stocks too much
Okay.
because they tend to have weaker balance sheets. And so large cap to us, that is a reflection of our quality bias. And that's on a relative basis, they've held up quite a bit better than their small cap counterparts today and this year. As we just think, stay on the theme of diversification, though. We have about 25% of our of our total equity exposure in international stocks. And this is something I think, again, in Monday's update with you, Rob, we were talking about how really in the last couple of years, many investors were starting to question diversification. Does it still make sense when it seems like a handful of stocks in the US continue to drive the entire market forward, and international stocks have underperformed for so long? Why even invest internationally? And I think now we're seeing why.
Yeah.
They outperformed by the widest margin in the first quarter, I believe, since 1988. So really strong performance. And again, in these types of environments, it provides just another way to diversify away from an area where there's just a lot of scrutiny and a lot of unknowns right now. And so it pays to diversify. So yeah, so I'll leave it there for right now, though.
I want to talk about the comment that I brought up because I don't want to go untalked about. I talked about how we started the year at 22 times earnings on the S&P 500. That's typically very high. 16 to 18 is typically pretty normal. 12 to 14 is pretty low. So in the world of Goldilocks, 12 to 14 PE is a little too cold. 20 to 24, things are getting a little too hot. What do you think about this is actually a good thing for the market, maybe just to get back to more of a historical PE and not an overvalued PE? Or am I overthinking this?
No, I don't think you are, and it's something that we've been mindful of in recent months. Actually, in I'm just wrapping up the second quarter newsletter right now, and when I start writing, I always look back at what I said in the previous quarter. And so in that first quarter newsletter, one of the things that I mentioned was the fact that we're coming into a year after back-to-back years of 25% gains in the S&P 500. And sure, a lot of those gains were concentrated in a handful of stocks, but it was pretty good performance, even for the equal weighted S&P portfolio. So we came into the year with investor sentiment that was extremely elevated, and we saw that stock valuations, as measured by the price to earnings ratio, that PE that you mentioned, Rob, they were stretched and they weren't cheap. And it's not valuations like that. They aren't a timing tool, but I think it's helpful for knowing. It tells you about what expectations are going forward. And so when you see stretched sentiment, stretched valuations, it tells you that investors and stocks are leaving themselves vulnerable to disappointment, to downside. And so far, we've seen some of that disappointment come through in the last several weeks. And so that's why we're seeing stocks behave the way that we are right now. Doesn't mean the party's over. It just means that, yeah, we were probably due for a little bit of a breather, and we've now seen that downside catalyst. But stock valuations are a little bit more attractive. They're still trading above their historical averages. But it is something that we look at and we say, okay, it's funny to me that I've heard it said before that the stock market is really the only market in the world where you could see a 15-20% discount offered, and you actually see buyers turn away, as opposed to if you go to your favorite department store, if you're shopping for clothing, you see a sale, it gets your attention. A lot of people see stocks go on sale and they run the other direction. And so as investors, we want to look at this opportunistically. We approach it with a long-term perspective, right? And maybe it is a time to add risk to the portfolios, but maybe not, right? And in this case, we have a neutral allocation to stocks, meaning if our target, for instance, is a 50% allocation, then we're basically at 50%. We're not leaning in and going overweight right now. We're also not cutting risk exposure. We want to wait and see how this plays out. It's a fluid situation, and clients rely on us to make disciplined investment decisions, right? We are not going to react based on emotion. I think that's what clients look to us for, that discipline. And so it's really important to be thoughtful around any decisions that we make. We're going to wait and see how things play out. We're going to continue to watch data and make sure that any decisions we make are informed. And so for now, we are neutral. Just last thing on valuations, that denominator is earnings. So yeah, the price to earnings ratio.
Okay.
So that assumes that earnings are going to hold up, right? If we say that the valuation, let's just say, is 20 times earnings, or 20 times, it's saying 20 times next year's earnings. And so that is saying that we expect next year's earnings to remain at whatever the assumed rate is. What we're going to be looking for here with the earnings season about to get underway, it starts next Friday with major banks reporting. We want to make sure that the expectations for future earnings growth remains somewhat steady. What we're going to be on the lookout for is if expectations for earnings start to go lower because of recent developments, in which case, you hold the price equal and you have earnings go down, that could actually put upward pressure on valuations, right? On that price to earnings ratio.
Get it.
I risk getting a little wonky there, but I think that's important to mention. I think that the earnings outlook is going to be really important here for stocks.
So final question, I've taken up an enormous amount of your time and you can give a quick answer. Other than contacting your financial planning team, which I think everyone should always do on a regular basis regardless, what advice would you give your sister right now? I'm sure, I don't even know if you have a sister, but let's call your hypothetical sister calls you up over the weekend and goes, "Oh, that was quite a week, Adam. What do you think?" What advice would you give?
Yeah, look, and I'm happy you mentioned the financial advisor because that really is the most important thing right now. If you're losing sleep over this, if you are nervous, you really want to make sure that you are controlling what you can. That's your financial plan. So get with your financial advisor, make sure that financial plan is updated because that will account for moments like this. It accounts for this type of volatility that we see. And so yeah, look, if I got a call from my sister, I do have one. I don't imagine that this is on her radar right now. But if she did ask, I would say, look, this as uncomfortable as this is, it is this is normal. And history does not repeat, but it often rhymes. And this is very, very different than anything we've seen recently. We've seen this is different than the global financial crisis. This is different than from COVID, but it's similar in the fact that we are seeing a flight to quality and people get really, really nervous about the outlook going forward. And so I think it's really important to remain disciplined, maintain that long-term perspective, because what we've seen every single time is that you're rewarded for that discipline. That staying in the market allows you to capture that upside when things ultimately rebound. And look, when you see these periods of volatility, they're often followed. Some of the best days in the market historically have come the day after or a couple days after the worst days. And so what you don't want to do is have a knee-jerk response and capitulate at the wrong time.
Sounds good. We will keep this channel open. We will continue to give updates. This has been a special edition of the Informed Investor Market Outlook. I'm Rob Black. He is Adam Phillips, Managing Director of Investments at EP Wealth. Don't be shy. Reach out if you need to. Have a good day. Talk to you soon.